Hey, good morning, everybody, and welcome to this Tuesday, May 27th, 2025 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and certainly a pleasure to be with you all. Hope you enjoyed a nice long holiday weekend. We're back at it again. The market futures pointing up, looking to potentially bounce off some 20-day tests that we saw last week. Also, we had moved down into some key gap support area, and that combined with, I think, just being maybe just a little short-term oversold, leading to a little bit of better action this morning, or at least as of about 15 minutes ago. You never know in the market. So we'll take a look at the futures here in just a minute. But overall, market seems to be behaving pretty well. We talked about the market being a little bit overbought after the huge rally we had off of the April 7th low. We had some sentiment issues, a lot of folks buying calls versus puts. So we had really low 5-day moving average of our equity only put call ratio. And historically, if you followed me over the years, you know that when that 5-day moving average drops down below a certain threshold, which I use at 0.55, it had gotten down recently into the 0.4s, which is very complacent, meaning that the market just probably has gotten a little bit ahead of itself, needed a pullback, and we saw that last week. So overall, I think the market's behaved, pretty much as expected. But 20-day moving average 20-day moving averages do provide some opportunities. And I think that's, a little bit of what's going on this morning. So let me go ahead and just give you the futures here. Hold on one second. So right now we've got the Dow Jones Industrial Average actually down this morning. Things do change. Literally 15, 20 minutes ago, everything was up. So right now, diamonds are down about 0.5%. We've got the spider. I don't know, maybe must be one Dow component or something, because actually the spiders are up nicely, up about 1.3%. Let's take a look at the QQQ, which is the ETF that tracks the NASDAQ 100. That is up almost 1.5%, up to 516.72. We had closed at 509.24 on Friday. And then IWM, which tracks the Russell 2000, currently up 1.6%, up more than $3.25. So pretty nice start to the morning. Must be one of the Dow components again that's getting hit. Not sure which one. That must be one of the bigger ones, must be taking the hit. We'll take a look at that. That's one of the things I'm going to try and get to today, is to go through the Dow 30 stocks if we have time, just to give you an update. I try to do this periodically, but I'll go ahead and do that for you in just a little bit if we have time. But I do want to just mention what happened on Friday first. You can see from this table, and I'll zero in for you, make it a little easier. Dow Jones down 256 points on Friday. S&P 500 down 39. NASDAQ down 188. On a percentage basis, you can see the NASDAQ down a full 1%. So that was the laggard on Friday. The small cap area down not too bad. Small caps down about 0.5%. And mid caps did best of all, dropping less than 0.2%. The VIX, you can see the VIX jumped again on Friday, went back up to 22, never got below that 16 threshold that I've talked about. When you go below 16 in the past, that means that that enough negativity and fear and panic has come out of the market where bear markets simply cannot thrive. That's one ingredient that's necessary for a bear market. We've got to have fear, got to have a little bit of panic in the air. And we were getting close to getting below that 16 level on the VIX before turning back up. And we are in the 20s. So anytime you got the VIX in the 20s, even though it has been on the way down, still a VIX in the 20s makes me a little worried about, what might happen at the opening bell. Again, today looks like we're all clear heading into the open, but we had some gap downs last week. In fact, those gap downs accounted for most of the downside action, which I thought just kind of continued the manipulative type of market environment that we've been in for about the last 6 or 7 weeks now. Actually, going back even further than that, I would say maybe all the way back to March 13th bottom, which would be more than 2 months ago. So there's been a lot of gap downs. And what I mean by that manipulative behavior is that there have been a lot of gap downs to account for a lot of the downward action since March 13th. And intraday, we've actually seen a lot of buying. And so even though the market kept going down, it was starting to appear that Wall Street was accumulating stocks again. That proved to be a very, very valuable indicator back in 2022 at the bottom in June of 2022. And it played out almost perfectly again when we reached the bottom in early April. All right, let's take a look at the, I want to go in and take a look at the sectors, and then we'll take another gander at the S&P 500 and some of the major indices. But when we look at the groups on Friday, with the market down, kind of makes sense. Utilities and consumer staples led the way, actually rose on Friday. But again, those are defensive groups. Real estate, another defensive group. That makes up 3 defensive groups out of the 4 that were up on Friday. When you look at the aggressive groups, look at the bottom. You got technology, discretionary, communication services, financials, industrials. Those 5 are the aggressive groups. And those bottom 3, technology, discretionary, and communication services, those are what I consider to be the most aggressive. And so when the market's going up, we want to see those areas of the market lead to the upside. Gives us much better feeling about the sustainability of the move to the upside. But with them all down, kind of normal on a down day for these 3 groups to pull back, because this is where most of the strength has been. So that's where we're going to see most of the profit taking. At least that makes sense to me. So overall, I thought the action last week was so-so. Again, most of the move to the downside was on gaps. And we'll take a look at that S&P 500 so I can show you a little bit about what was going on. You can see after Monday, we gapped down on Monday and then rallied, finished at the high of this push off the April low. And then the last 4 days of last week, you saw a gap down on Tuesday, gap down on Wednesday, gap down, slight gap down on Thursday, and then another gap down on Friday. But Wednesday was the only day really that we saw any concerted selling during the trading day. You can look at these candles. And again, let me blow these up so you can get a good look at them. But you can see that there was hardly any further selling after the opening bell. And on Friday, when we gapped down and went down, touched the 20-day moving average, or nearly touched the 20-day moving average on the S&P 500, you see buyers came back in. So, when you look for opportunities to get into a bull market, what I believe is a secular bull market rally, I think we're going back to all-time highs. When you have that opportunity on the 20-day moving average, that's basically the best time, in my opinion, to get back in. And again, we're seeing futures up. We don't know how the market's going to do today and the rest of this week. It is a holiday shortened week, but I can tell you that historically, this period going out to about June 5th or 6th is one of the best periods of the year historically. Again, if you follow our work at Earnings Beat, you know that the 26th of all calendar months to the 6th of the following calendar month, those days, it's only 10 or 11, 12 trading days, depending on the month. They account for over 80% of the gains in the S&P 500 since 1950. You've got portfolio managers, hedge funds, and so forth that are buying stocks ahead of the money pouring in at the beginning of the month. You get a lot of new money coming in, 401k money, things like that. Some pension funds and so forth comes in at the beginning of the month that drives the market higher. And then you've got those that are anticipating that money coming in that drive it higher at the end of the calendar month. So it's not something that happens every single month, but over time, it's very apparent that the tendency is for stocks to go up at the end of calendar months and into the beginning part of the next calendar month. So here we are, May 27th. Again, this period coming up over the next week to 10 days tends to be very, very strong for stocks. We'll see what happens. Let me go back. I want to show you a couple of others here. That was the S&P 500. So let's take a look at the NASDAQ 100. NASDAQ 100 did not get down to that 20-day moving average, but you can see they got back to gap support. So the top of gap support when we opened at about, 20,800, got all the way up to almost 21.5. Actually, it looks like maybe we did test it on Wednesday. And then we came back down and essentially we've tested the top of gap support. Still a little bit of room to the downside on the NASDAQ. I don't know if we hit that 20-day or not before we try to maybe go back up and set new highs. But we did get a nice pullback over the last 4 or 5 days. All right, next up, let's take a look at the small cap area, IWM. Another one that went up. We actually saw a gap down on Friday that took us below the 20-day, but we came back up and essentially held it by the close. And the IWM, like I was talking about earlier, in pre-market at least, IWM showing the strongest gains. So we'll see whether or not that holds. Looks like we'll gap up above that 205 level, and then we'll just sit back and see if that 20-day moving average, which is at 202.34. And also now we've got this gap support from Friday down around 200, maybe just slightly below 200. That's going to be a key area of support, I think, going forward on the IWM. I'm going to pull up the transports because this is a group that still lags the S&P 500. But look at this test of the 20-day moving average. Nice little hammer printed on the 20-day moving average just as it was testing the top of gap support from May 12th. So that looks good. Then you go to some of the sectors, the XLK, which is key. Here we were, very stretched, came back down, essentially filled the top to the top of the gap, and still a little bit of room to the downside to the 20-day moving average. XLY into the gap area, the gap zone, hanging above the 20-day moving average. XLC, same thing, not quite as far of a pullback, not quite as much of a pullback as we've seen in other areas, but we are still hanging up obviously above that 20-day moving average. Similar themes throughout the market. 20-day moving average, we've gotten those golden crosses where we've gone back through the 200-day moving average, 50-day moving average, and then prices continue to trade above both of those moving averages, which is a bullish configuration. That's what you want to see on charts, and that's what trends are made of. Price action trending above 20-day moving average, which trends above a rising 50-day moving average. And you can see that 50-day is starting to curl back up and it is now starting to rise again. So this is bullish configuration. It's bullish action until it's not. I mean, you can fight it if you want. I'm going to ride it. I'm staying with the long side. Been talking about this now for probably 6-7 weeks since beginning of April. Once we went down that 20%, historically speaking and generally speaking, when you go down 20% in the market, pretty good idea to maybe start thinking about buying. That's been the history of stocks. All right. Let's see here. I didn't want that. What was there? There we go. All right. So this was the Dow component. So I'm going to try to go through these. Let's see what time we got. I got about 15 minutes maybe. But I'm going to try to go through these. I don't have, and these are long-term, by the way. You can see the first one here is Goldman Sachs, but this is a monthly chart that's going back 20 years. So this is a long-term view of the Dow stocks. And I've got them in order. Well, I put them in order probably a couple months ago in terms of their weighting in the Dow. That may have changed because it's a price-weighted index. So as prices change, the weighting will change. But generally speaking, this is a pretty good indication. I know United Health got hit, so that's going to be one that's going to be much lower than what it currently, or what I'm going to show you in terms of the percentage of the Dow weighting. But here's Goldman Sachs. Goldman Sachs trending up. And remember, this is a monthly chart. So this is a 20-month EMA. We went back and we tested that with a PPO that was just going straight higher. When I see that, that's what I look for. I look for a 20-month test. And actually, I will pull up the S&P 500 and take a look at the S&P 500. Everyone's talking about this horrible bear market, but really all we did is we went back and we tested the 20-month EMA. Intra-month, we went down below the 20-month EMA, but came back up by the close and we finished above it. So longer term, it looks like we break back out. This was simply nothing more than a 20-month EMA test. And we've kind of seen those before. If you go back, I mean, here was 2015, 2016. And I thought there was another one back here that, well, there have been some that have come down and tested, but not necessarily gone through. Here was one back in 2014. where we came back down, tested that rising 20-month EMA before moving back higher. Anyway, just wanted to point out S&P 500 has done this, and a lot of the stocks that we look at, you'll see that as well. So here's Goldman Sachs. Let's keep moving. UNH, like I said, the weighting is going to be completely different. This is no longer one of the top weighted stocks because of the hit that it's taken in its price over the course of the last couple months. Overall, we had a nice uptrend until recently. Now, for the first time in over a decade, probably 15 years, we're now trading below the 50-month moving average. UNH got a lot of work to do. We may at some point see a rally back up into the 300s, maybe even get back up to around 400. But longer term, the chart does not look good. Looks like it's broken, and it broke on very heavy volume. You want to be careful with UNH. Microsoft looks beautiful, continuing to move up. We saw the gap up to start May, and it has just continued. That was an earnings related gap. Normally you don't see gaps on monthly charts because the gap literally has to happen on the first day of the month. But that's apparently what happened. I think Microsoft reported on April 30th and then jumped on May 1st at the open. Anyhow, Microsoft looking to break to new highs. Looks great. Home Depot consolidating. And again, some of these charts on the monthly chart just look like they're having these little pullbacks. But if you look at them on a daily chart, you think the sky's falling. That's the beauty of going back and looking at long-term charts and getting that long-term perspective. Otherwise, you get caught up in the day-to-day stuff. You react to the news, the media, which is a big mistake, in my opinion. Anyway, Home Depot, I think, looks fine. It has gone down on multiple occasions the last 5 years and tested that 50-month moving average, which is what it just did in April. Caterpillar, beautiful uptrend, came down, essentially tested that 20-month EMA, and now it's back, heading higher again. Sherwin-Williams, looks to me like we had a little cup, came back, tested the 20-month moving average, broke out. I think eventually we're going to see this stock rally to maybe about, I think it could go up to 500 based on the measurement off of this cup. So that's what I would look for. I think this pullback on the monthly chart is an opportunity for long-term entry. CRM, that's Salesforce.com. Very similar looking chart. I mean, it almost looks like maybe a little lengthier cup. Handle back to the 20, breakout, come back down, test the 20. I think long-term, you got another winner here with CRM. Visa continues to trend up. It's probably a little overbought. You can see the weekly RSI down here well into the 70s. Sometimes, when you get up in here into the 70s and 80s on a weekly basis, you could see pullbacks, but also you can see the stubbornness of a secular bull market and the fact that we just continue to power higher and higher and higher. Got to be willing to break yourself away from all the news that's out there. Look at the charts, see what the charts are telling us. Short term, I've seen manipulation that tells me that the market's going to go higher. And when I look at the charts are telling me we look like we're ready to go higher. Next, American Express, another one broke out in 2024. Recently got that pullback to test that rising 20-month EMA. Seems to be fine at this point. McDonald's just continues to push higher and higher. It's not exactly one of the stocks that's flying in the Dow, but it continues slowly to make its way higher. Nice long-term chart there. Amgen has pulled back quite a bit, probably an opportunity long-term as well. This is in healthcare, and healthcare has been absolutely bludgeoned in 2025. So I think part of this could be just being dragged down with the overall group. But I think anything from 240 and this 260 range looks pretty solid to me for Amgen long-term. Apple, I know Apple, again, on the daily chart, you look at it, looks like it's horrible, and it is relative to some of the other Mag 7 stocks and the S&P 500. It's been underperforming. But you look at it on a long-term chart and where it sits now. I mean, look, every time we've had one of these pullbacks in the last 20 years, when we're at or close to that 50-month moving average, it's time to buy Apple, and we're just about there. Travelers, another one that's just beautiful uptrend, continuing to bounce above that 20-month EMA. JP Morgan, one of the top banks. If you're looking for a nice bank, pays a decent dividend, JPM might be the stock for you. Long-term, obviously, it's gone through, some difficult times. I remember the, of course, financial crisis back 2008, 2009, pulled out of that, had a little bit of maybe some aftershocks, if you will, in 2011, 2012, but then we got on this path higher, and any pullback to test the 20 and especially the 50 has been a great opportunity in JP Morgan. Honeywell's been more sideways consolidating. So a breakout above 240 with some volume is what you want to look for here. IBM, really after years of consolidation, I mean, a decade of consolidation, the last 2 years has been very, very strong. And I see nothing at this point to slow down IBM other than, just a typical pullback that, we'll probably see a 20-month EMA test at some point down the road. But we haven't seen one of those now for over a year and a half. Amazon broke out back in the middle part of 2024, has come back down, tested key area of support. Looks to me like it's poised to move higher. Boeing is probably one that, if you've been in, you probably wish you had been out of for a while. But there are some positives that have been taking place on the shorter term charts, and it's beginning to show up on the long term. But what we really want to do is get a move that takes the monthly PPO back above zero, and we need to sustain that. And the way you do it, obviously, is with prices to move up. Can't keep going sideways. You need a trend. Maybe we've started that off of this latest low. You can see that 125 area. Pretty strong support going back the last several years. Boeing continued to bounce off of that. So maybe this is it. Maybe this is the push we've been waiting for on Boeing. Procter & Gamble continues to trend higher, but kind of like McDonald's, it's not a fast mover, just slowly making its way up. Great long-term, buy and hold type of stock, pays a decent dividend, and over the long term does provide capital appreciation. CVX got hit back during the month of April, and you can see this support area right about 130, and we're sitting at 136.54. It would seem like this is a great time to jump into CVX. J&J, Johnson & Johnson, another one really hit by the healthcare problems in 2025. We were up near an all-time high back in March, and then, of course, April hit. We went all the way back down to the recent lows around 140. So we're in that trading range, but ultimately I'd be looking for a breakout of that range. NVIDIA, huge move to the upside in the in 2023 and 2024. Had a little bit of a break in 2025, but we are moving pretty nicely now. 3M, look at these tops coming across here. This was 160. This was 150. This was almost 160. Got to get through 160 on a closing basis. Just bounced off of that rising 20-month EMA. This could be the move that takes us up. We're certainly in a nice uptrend over the course of the last 18 months or so. So 3M, if we can get through that 160, 165 level, that would really be a nice breakout for the stock. Disney, after consolidating, this $80 level has been holding since all the way back in 2014. So we've got 11 years worth of support around 80. We were just back down at 80 in April. May's been a really good month. We've recovered. Got to get back above this 50-month SMA. So we've tried it a couple times, early 2024, late 2024, early 2025, have not been able to get through. We've now been under this area for more than 3 years, or under this moving average for more than 3 years. Can't go anywhere until you get above that 50-month moving average. Merck, still under a lot of pressure. I kind of like the stock for the long term. I mean, it's been hit hard, but again, healthcare has been hit hard. And maybe it continues to struggle for a period of time. There's nothing right now that looks to me to say, hey, that's going to turn here, other than we did see some tops. Here was one at 75. Here was one around 80. We broke above 80, went back down, tested 80, and now here we are sitting at 77 and change. So we're close to that support area. But if you look at it monthly, we continue to put in lower lows and lower highs. I think it's important to change that trend. So until we get a monthly high that goes above the prior month's high, probably best to just kind of watch this, unless you're in it for the long term. Merck does pay a nice dividend. So if you like the dividend, and they've been paying it for a while, raising it. And so if your philosophy is a little bit longer term and you want the income, a stock like Merck makes a lot of sense for the longer term. Walmart just has been a steady advance since the beginning of 2024. Another stock that's just had a great long-term run. it got overbought. Look at the weekly RSI getting up close to 90 at the end of 2024 and early 2025. So we needed a little bit of consolidation to bring the RSI down. We've gotten some, but I would probably look for a little bit more consolidation in Walmart, maybe even back down into the 80s, getting close to the rising 20-month EMA. And then I think maybe it could be a solid buy there. Nike continues to trend lower. This is one I would avoid in the short term, but again, from a longer term standpoint, this is one that I think probably turns the corner. But footwear, that entire group has been very, very weak for a long time, and Nike is part of that, part of the reason for it. So I probably want to see a little bit, maybe get back through that 20-month moving average. But from a longer term perspective, probably, again, if somebody has staying power and wants to wait for a possible turnaround, and it might take a couple of years for Nike, but I think longer term, you probably see some capital appreciation there. Coke continues to be a solid performer, rising just about every month, up near its all-time high right now, and you can see its uptrend since 2009 has been pretty steady, with the exception of the pandemic. So another great long-term buy and hold. Cisco broke out above this double top back at the end of 2024, early 2025. Went back, we tested that 20-month moving average. Now we're moving higher. And the last one I have for you is Verizon. Verizon's had a nice last year and a half or so, rising from 27.5 up into the 40s while paying a nice dividend to boot. But it does have some overhead resistance around 47.5, which is where we got close to back in March before pulling back. Might take a little time to get through that level. That is a key resistance area up around 47.5. So I think it's probably just a, back and forth, maybe from 37.5 to 47.5 in that range. We're sitting almost right in the middle of it right now. That's what I would look for out of Verizon. So anyway, that is it. Got through the Dow 30 stocks. Hadn't done it for a while, so I wanted to give everybody a quick update on that. If you are new to Earnings Beats, I want to point out a couple things. First of all, go over to earningsbeats.com. That's our home, both plural, earningsbeats.com. You can scroll down. I do want to mention that we have a limited time offer. Said it expires, but I think we've extended it. I'm not quite sure how long, but probably for the next couple of days. But right now is the time. If you like what we do at Earnings Beats and you want to give us a try, this is best time to do it. This is our spring special. You can save 20% or $200 on our annual plan, which is about 50% savings off of our monthly plan. So definitely take advantage of that. You can also scroll down. We have a free newsletter if you want to learn more about us. We have a free newsletter, only takes a name, email address. Go ahead and hit that subscribe button. We're good to go. If you want to just try our service for 30 days, no cost, free for 30 days. Of course, the special will be gone by then, but you can sign up for a 30-day no-cost trial for our service. You do have to give credit card for that, but not for our free newsletter. No credit card required on that one. But please be sure to hit the like button and subscribe to our channel. That will really help us in building our community here on YouTube. So we certainly would appreciate that. Even if you're not a member, or you can't afford to be a member, you don't want to be a member, that's all fine. But we'd love to have your support here on YouTube. That would really help us. All right, let's see. The market open. Nope, we got 2 minutes to go, and I'm basically through everything I wanted to talk about. One of the things I'll point out, let me just go over. I want to just get to one of my chart lists. So one thing that we do at Earnings Beats is first, we want to make sure that we're trading leading stocks and leading industry groups. And one of the ways we do that is by following the earnings groups relative, or the industry groups relative to the S&P 500. And so let me see. Here we go. So here are the industry groups. So let me just show you a couple of the industry groups that are doing so well right now. One of them is aerospace in the industrial area. So if I pull up this chart, this is a 3-year relative chart, 3-year weekly relative chart versus the S&P 500. But let me get aerospace. There we go. Now down here on the bottom, you'll see the actual breakout on there, just on the price chart of aerospace. So this is an absolute chart, not a relative chart. This is just how aerospace has been doing. Made this breakout above the double top in February and March, and you can see it has been just about straight up. This has gone from under 2,000 up to 2,600 in the course of less than 2 months since late March. So, I mean, we're talking about, I don't know, what is that? 600 points. It's over 30% move in aerospace. And look at the relative strength. This is how much it's outperforming the S&P 500 by. Even before we made the breakout, even before we made this breakout, you can see all the way back into December of last year, that's where we bottomed on a relative basis. Aerospace, if you've been in leading stocks in aerospace for the last 6 months, you're probably pretty happy with how your stocks have performed because of this significant outperformance. So this is what we want to look for as we go through. We have all the industry groups in this one chart list, and I can go through this probably in 10 minutes, go through every one of them in 10 minutes, 100 charts, and I can tell you the top 10 or 12 industry groups. And then from there, we have other chart lists where we can go in and look for leading stocks in those 10 or 12 industry groups. And that's how you put together a portfolio that beats the S&P 500. So anyway, market is open. So let's see where we are. Dow's up 400 points today. We got NASDAQ up almost 300 points, up 1.5%. So solid open. It has followed futures. Small caps up a little less than that, though. Small caps up 1.3%. Overall, though, great start to the day. Let's see if we can see what's leading. We got Tesla up $11 to 350. There's Palantir. Some of the normal leaders that we see when the market is in rally mode. So we got a little bit of a pullback last week. We're getting a little bit more of a rally now this morning, maybe off those 20-day tests. This could be a move right back up past 5,900 on the S&P 500. We're at 5,871. And we're not far from that 6,144 all-time high. We're certainly a whole lot closer to that than we are to the 4,800 bottom that I think a lot of folks are erroneously waiting to test. I just don't think it's going to happen. Could we go back to 5,600? I think maybe. That's about where I draw the line. I just don't see a whole lot of downside at this point, not based on under the surface signals. I'm not just talking about the S&P. I mean, yeah, the S&P goes up and down, but the signals that I like to follow, where I call tops, where I call bottoms, right now they're supporting this move to the upside. So I think the more likely move is back to the upside, not to the downside. Anyway, that's where I see it at this point. Listen, have a great rest of your week. It is holiday shortened, so we'll get to Friday a little sooner than normal. That certainly makes me happy, maybe some of you as well. But have a great rest of your week, everybody, and happy trading.